We are in conversation with the head of equity and credit of APAC and chief investment officer at UBS Wealth Management, Hartmut Issel. He needs no introduction. A lot of Indian viewers now know him very, very well. And Hartmut, it's a pleasure talking to you. Thank you so much for taking the time out and speaking to us.
Always happy to be on the program.
Thank you. And I wonder if investors will say that they are always happy to be in India because 2025 wasn't quite a year wherein global investors would have been happy being in India. Can 2026 be different?
I think to some extent it can be different because the sort of gap between, whether it start with valuations and then, of course, AI coming in, or especially on China, of course, was very, very interesting to watch the tech side, etc., which, that sort of market structure like we see in MSCI China, for example, they have. That actually, in our view, also remains interesting, remains the case. But nonetheless, right, so we had the performance numbers a bit moving closer together, right, compared to previous years. So, sets the scene new for India. And India has very different drivers, of course, right? If I compare to North Asia, like your Taiwan, your Korea markets, for example, right, and then also Chinese markets. So it has its own drivers, and this is also quite interesting. Right? As a matter of fact, I would argue we don't see many markets, or we don't expect many markets where we see an uptick in earnings the second year probably in a row. In India's case, the fiscal year 27, that we expect to see, and we have done the work on the numbers, so we're quite convinced the fiscal year 27, the earnings uplift will be even higher than it was in the current year, so 26. Yeah, so actually interesting stories also, I would say, for investors from outside India to look at the market again.
Okay, so Hartmut, the constant issue with Indian markets always perennially has been valuations. Now the added issue has been the trade deal, but because it's been spoken about so much and expected so much, that in some sense the markets are learning to live without the US-India trade deal. So let's assume that trade deal is getting delayed or not happening for whatever reason. Will earnings growth and the GDP growth and the uptick in earnings growth in FY27, I believe you're targeting some 15-16%, will that be good enough to draw equity investors which have stayed out of India for a better part of 2025?
Yes, I mean, when we look at the numbers, and also coming from the trade deal side, so you have two big sectors, of course, in the Nifty. Right? One is the bigger one of them is, of course, IT services. Right? The other one is healthcare or pharma, where we, as we all know, right, also our audience here in India, of course, very well knows, right, both of these sectors have been excluded. Right? Services not in there, or IT service certainly not in there, and generics is not in there, right, for the right reasons. Right? That would also be a bit difficult for the US to justify it or to live with tariffs on that side. So, and taking these two out, that there isn't that much left actually on the earnings front in the Nifty, or even outside the Nifty for that matter, where we would say, but still, right, from the trade side, or from these, at least the announced, right, the nominal tariffs, 50%, there would be a lot of impact. Very, very few companies that have a little bit of impact there. So therefore, and I think my view is that investors have never really looked at it so much from the equity side in the first place. And I hope I was able to also lay out why this is the case. So even if the trade deal then eventually, I mean, of course, we're all thinking it will happen eventually. Maybe a bit macro impact there, positive one, hopefully. But on the earnings side, or especially the equity side, I wouldn't expect a really positive move from that either. Maybe it helps the currency a bit, the INR.
Ah, okay. So you're saying it happening does not have a positive move, but am I understanding you correctly that it getting delayed will not have an incremental negative impact too?
Now, if I look at it very closely, it never had a negative impact to begin with, right? When we saw the 50%, I mean, very few of us, I guess, including, again, India audience, would have expected this. But it didn't really move the markets down a lot, right? And it shouldn't, because the two biggest sectors that are exposed to the US, they're both excluded. And therefore, that's where I'm coming from, right? When it hasn't had a negative impact really on the stock market in the first place, then sort of coming to a negotiation or coming to a settlement between US and India, then should also not, it by itself, pull up the index either.
I hear you. Okay, so it is earnings growth, GDP growth, and valuations relative to the rest of the world, all of which, Hartmut, one would argue, are better keep India better placed at the start of 2026 than what it was at the start of 2025 or mid-2025. And kind of earnings also dipped a little bit before picking up again. My question is, I was looking at your strategy note dated 23rd December, if I'm not wrong, and it seems that while you might be top-down, mildly constructive on India, if I can word it that way, there will be a need of a lot of smart bottom-up strategies for investors to make in 2026. Would that be a fair assessment of your thoughts?
I would put it this way. Overall, right, this market, or Nifty for that matter, should be driven by the earnings growth side, right? So we're coming, if I still remember back to March this year, so basically fiscal 25, right? We were sort of mid-single digits, and so in our numbers we had a slightly over 6%, which is very, very low for the Nifty, right? So we think we can already inch up for the next March towards very slightly over 10%, so already getting back to double digits. So that's one lever of improvement. The next lever for improvement that we're seeing in our numbers is then indeed the fiscal 27, where we have, as you rightly mentioned, right, slightly over 15%. So we get 2 years in a row where you get an uplift, and that is something, both the actual earnings numbers as well as the fact that we're uplifting 2 years in a row that the market wouldn't ignore. And in my view, if I look at the end of, we already mentioned, right, the outlook for 26, if I look at the end of that calendar year, we should be up, I think, even if you push me for forecast, slightly above actually 10%, so close to 30,000 on the Nifty. This is, I think, a very fair assumption. In terms of sectors, also that you just mentioned, right? Yes, indeed. I mean, to some extent, we look at certainly the financials, right? A sector to also from a valuation point of view, that's one of the few where you cannot make the argument that it's very high or very demanding. But then there's also other sectors that haven't done well at all, or subsectors for that matter, right? Oftentimes when they were seen as sort of a bit of a victim of the AI situation, and now we're more and more seeing that it's actually unlikely to happen. So those could come back. They have actually not only lagged, they have actually really gone down, right? They're starting to come back, and I think this is another interesting story for 26.
Wow, okay. I heard you say 30,000 on the Nifty, right? Or a 12-month target. Did I hear that correctly?
We could say 29 at least, I would say, right? Okay. Then you come to 10%. But since we're expecting actually in the 27 fiscal year around 15%, so even if the valuation doesn't change at all, which it may well not be, right? But you could actually argue that it should be slightly over 10% in terms of upside.
Yeah. I mean, between 29 and 30, it's what, 3.5%, 4%. So hardly makes a difference one way or the other. So completely fine. The choice of pockets would be very interesting, like Hartmut. Like, I don't hear very large global houses choose, let's say, for example, a BHEL, right? And I'm not asking you for a comment on BHEL, but just that bucket of, or that cohort of stocks that BHEL would represent. It's a PSU, it is capex linked, and the government has made a decisive pivot towards consumption, both via budget, tax cuts, as well as the GST cuts. So it's an interesting time to choose a PSU capex play. Now, like I said, I don't want to comment on BHEL, but what prompts something like this?
Yes, I would say, I mean, if we look at, say, capital goods or industrials as a sector, yes, that is that is something where things split a bit apart, right? Not everything in industrials necessarily, has the same outlook from what you rightly mentioned, right? So since a couple of quarters by now, we are aware that the consumption side pulls a bit up, right? The government tries to put a stronger effort on that, and of course, money has to come from somewhere. So maybe a little bit less on some select subsectors in industrials, but I wouldn't put the entire sector into it, because it's clear on the defense side, certainly there is not much of a pullback. And then also for the power side. The power side is also one of the subsectors where we're not seeing actually a lot of slowdown, and also names that you mentioned, they belong into this. So we also have, at least to some extent, right, we're not a full overweight on industrials, but where we put inside industrials, the focus points are exactly there: defense and also to some extent power generation.
Interesting. Okay, and is the UBS view between capex and consumption, or capex versus consumption, different for 2026 and 27 based on the earnings growth estimates that you have? In that, is consumption now a lot bigger or lot higher a weightage versus what it traditionally would have been in the last 3-4 years?
Yes, we have taken it up already earlier this year, so on the consumption side in general, or consumer stocks, if you will. And that also seems to be playing out, especially some of the really large ones. If I think about retailers or those stocks, and of course, some of the largest, if not the largest in India, right, where we have retail businesses as one of the components, doing very, very well. So that's not so surprising. And yes, indeed, on the capex side, we have become much more selective. So naturally, we're not going back to zero or a complete massive underweight, but yeah, we are a bit more on the underweight side, and we have put the focus, as I mentioned, more on defense and power, and then some other subsectors where we're not really that present anymore. So yes, your observation is correct as such.
Okay, and Hartmut, again, the overarching view amongst almost everybody who invests, who's an investor, local mutual funds, global money managers, etc., is that within consumption in India, they want to go to the high ticket discretionary consumption, the upper end of the K curve, whichever way you describe it, because the premium consumption, because that is what will probably show faster earnings growth because of the GST cuts and the tax cuts. Are you more constructive there, or are you constructive, let's say, the staples or the non-discretionary consumption bit in India? And if it is within the discretionary, what within that bucket do you like more? Is it vehicles? Is it air cons and consumer durables? Is it something else? Can you talk about it?
Yeah, vehicles to us looks a little bit, and of course we have seen the uptake, right? But whether that's something we can say, oh, for the next, I don't know, 1, 2, 3 years, this is, a general trend. I mean, we're already seeing these numbers coming down a little bit again. On the other hand, areas, even in food and beverage, for example, right? And yes, I know some of the investors say, right? I mean, there's only so much food or so much beverage you can consume, right? So just because GST goes down doesn't necessarily mean you're going to buy more volumes, and I would agree with that as such. However, it depends a bit on where these stocks are valued, but some of them are also a bit, or have come off a little bit, right? And then when I think about, okay, but what drives the consumption here is, right, when the goods, or especially the beverages, food, etc., become a bit lower, right? Your affordability goes up, so consumers will have also, even on these areas, a tendency to premiumize things a little bit more, right? Because they can afford it now. So I wouldn't completely rule this out on the consumption side either, even though we also like the higher end consumption, but I wouldn't only limit it to that.
Okay, Hartmut, my final question would be, what are the risks to this theory? I mean, one, of course, will be that earnings growth doesn't quite shape up as well. But I heard you say that you've done your homework and you're very confident there. So that's presumably not a risk. What is a risk?
Yeah, if you ask me, especially also from within, or from the domestic side, right, where there's something that we're watching and also see here and there some signs that would be better maybe to take a bit of pause here, is certainly the be it IPOs or be it secondaries, right? So the material, that the capital really that flows in the market from that side, right, where we're thinking, okay, if that also was cooling down a little bit, but maybe a little bit less on the IPO side, a little bit less maybe on the secondary side, that would additionally support. I mean, the earnings, as you have also just mentioned again, we're very, very not worried at all actually about. But yeah, right, the capital side of things, when that saw a little bit of cooling down, that would probably also help the markets a bit to see that 10 or slightly above 10% that we're expecting here for the next year.
Interesting. Okay, Hartmut, sorry, can I just take a follow-up to this? A lot of people who are looking at Indian capital markets and flows, domestic flows being so high, also argue that if it were not to be for the IPOs absorbing the liquidity that is coming in out of the domestic retail investor, then the valuations of the secondary markets would actually go sky high very, very rapidly, because the domestic flow is not stopping. Would that be a welcome thing, that India is coming out with so much of paper that it is absorbing the incessant amount of retail flows that are coming into the Indian equity markets?
Yeah, for me, it's more a question of timing, right? I mean, as such, it's also good, right? So certainly IPOs, but the market needs it. Every market has that, right? So India is on that point now, certainly, right? Where in the Nifty we have more the, I call it traditional economy, right? Banks, etc. Right? Stocks we mentioned here, power, etc. Right? And now more and more the, be it quick commerce, be it maybe telco IPOs, it seems, right? But some of these are internet-based, I should say internet-based business models, right? Over the last even 3 years by now, right? So many of them we have also seen, and this is quite normal for every market, right? That as the market develops, these kind of new industries also are taking shape and coming in. So that is in itself a good thing, because they, of course, they offer also higher growth compared to some of the more traditional sectors, right? So if we then, even in a Nifty, right, over time see a different composition, that's a good thing. However, if some of these happen a bit too fast, that can sometimes lead to a bit of heating effects, right, where it would be nicer if it all went a bit more linear. That was a bit what I was trying to lay out here.